Most investors don't quit because they're wrong. They quit when the market goes quiet, the payoff is delayed, and progress stops showing up on the screen. Today I'll give you one weekly checklist, a repeatable process you can run every Sunday that keeps you disciplined. When headlines get loud, spreads widen, and charts get messy, you'll know exactly when to act and when to pause. If you trade around CPI, Fed speeches, jobs reports, or earnings, this process stops you from overtrading the news and rage clicking during whipsaws. Instead of reacting in real time, you'll follow pre-written rules. The goal isn't to predict every move. It's to stay consistent long enough for your edge to appear. Free blocks, event MEP, levels, and risk. Do them on Sunday night. In about 15 minutes, and your week gets calmer instantly because decisions are pre-made. No guessing, no scrolling for opinions. Blocked 1. Build an event map. Put every market-moving item on one calendar. Then pre-decide your no-trade windows before you place a single order on Monday. This alone removes a huge chunk of unnecessary trades. Most bad trades come from surprise timing, not bad charts. A number drops, liquidity disappears, and you improvise. That improvisation is expensive because you pay the widest spread at the worst possible moment. Write 4 columns: date, event, expected volatility, and what you will not do within 2 hours of it, like adding size, moving stops, or opening new positions. Write the rule as a sentence you can read under stress. Examples: CPI, FOMC, payrolls, major earnings like Apple or Nvidia, and headline geopolitics. If it can move futures, it belongs on the map. Even if you don't trade those names, the market trades them. My rule: if it can gap a stock, it goes on the calendar. If it can gap the index, you'll reduce size. Block 2. Levels. You don't need 20 indicators. You need 3 prices that matter, and 1 moving average the crowd watches, so you're not trading alone. Levels keep you oriented when the feed tries to hijack your attention. Mark last week's high, last week's low, and the prior breakout level. Those are where decisions cluster. Because funds, algorithms, and retail all reference them. If you only mark one thing, mark those. For the moving average, use a simple 20-day or 50-day. It's not magic. It's a crowd reference point. That helps you judge trend, pullbacks, and whether a breakout is real. Keep it simple so you actually follow it. Then write 2 if-then lines. If price holds above the level, I wait for confirmation and enter small. If it loses the level, I do nothing, or I exit. No debate, no bargaining. Your future self will thank you for clarity. Block 3. Risk. This is where most people quit too early. Because they say it's too big. One bad candle feels personal, and emotions take the steering wheel. Risk is the bridge between a good idea and survivable execution. Start with one number. Maximum loss per trade. For most people, that's 0.5% to 1% of account equity. If that sounds small, good small keeps you in the game long enough to learn. Place to stop based on structure, not feelings. Decide the invalidation point first, before you decide the entry. Add a volatility rule. If candle range doubles, your position size halves. Same risk, smaller size. This one rule removes panic, because you expect the wiggles. Volatility offers less certainty, so you pay it with less size. This is how you avoid the quitting trap. You're not weak. You were under risk managed. Control risk. And your mind stays online to learn. Put it together. Event map tells you when not to trade. Levels tell you where to decide. Risk tells you how big to be. That's the whole game. Repeat it every week until consistency becomes automatic. When a headline hits, you don't need motivation. You need a rule you already wrote. Rules beat moods because moods change faster than prices. Example: CPI morning. Your map says no new positions pre-release. Your levels are marked, so you wait for the reaction. After the first spike, you look for direction, not excitement, and you size smaller than you think you need. That waiting isn't fear. It's professional risk management. Compounding is boring, but quitting is expensive. I'll ping my one-page template, an event map, 3 levels, and a tiny risk calculator. It's designed to be fast, not fancy, something you can finish even on a busy Sunday and still trust on a stressful Wednesday. If you want it, comment checklist, and I'll reply with the link. Also comment your market spy QQQ or your top watch list name, and I'll tailor examples in the next video so you can apply this immediately. If this helped, subscribe. One psychology plus process video each week. No hype, just repeatable decisions you can execute. If you're serious about markets, this channel is built for you. Next video: how to review a losing trade in 5 minutes, without spiraling, and without revenge trading. Remember, you are not late. You're early in the learning curve. Stay in the game. Keep risks small, and the process works. Drop checklist below, and I'll see you next time. Stay consistent, and don't quit on the quiet weeks.